Welcome back to Morning Markets on Wednesday the 14th of December. An inflation special this morning with some positive trends forming in the US and the UK. The headline story of yesterday was the publication of the US inflation print using the CPI metrics here. The report showed that the headline level of inflation remains above the 2 to 3% target, but is slowing, with the latest reading showing that headline inflation moderated to a level of 7.1% year over year in November. That's down from 7.7% in October, and it's actually below the market expectations. Month over month, inflation is still ticking up, but at a much slower rate. It increased by 0.1% in the month relative to the 0.4% increase which we had in October. Core inflation, which strips out the more volatile components being food and energy, also cooled from 6.3% in October to a level of 6% in November. So a positive direction of travel is starting to form there. This positive outcome is important in terms of the targets of the Federal Reserve. They've been working very hard in terms of their policy, the raising of interest rates and the moderation of the supply of bonds in the market, and also their messaging and communication to bring inflation towards that target level. In addition to the encouraging direction of travel in the US, we also had this morning the UK print, which too came in lower than October. The headline inflation print was 10.7% relative to the 11.1% which we had in October, and around 0.2% below what the market in the main was expecting to see. Core inflation was also lower, 6.3% relative to 6.5% in October. Just digging into the data, if we take the US as an example, the areas which are still pushing headline inflation up during the month include food, shelter costs and wages, whilst interestingly energy, gasoline prices fell, whilst energy and gasoline prices on a year-over-year basis are still some of the most significant contributing factors. In the UK, fuel prices were less of a contributing factor, whilst increased prices in food along with service sectors, including bars and restaurants, were more of a positive contributor to that inflation level. US and global markets have responded well to the result. We've seen bonds generating a positive return, with yields moving lower and equity markets providing a positive return. The US dollar was also weaker relative to a basket of international currencies, as this eases the pressure on the Federal Reserve to raise rates as aggressively as what we have seen in the past. What does this mean looking forward? Well, the trend is in the right direction. It's suggesting in the US we could be beyond that peak in inflation, and we may be getting some early signals of that here in the UK, but be aware we are still running above that 2 to 3% target in the US, but also here in the UK. So more work is required to bring inflation towards those levels. The timing is interesting. In the US, the print yesterday came on the first day of the two-day series of meetings of the Federal Reserve, where they'll decide on the future pathway of monetary policy. Today, we're expecting to see an interest rate increase in the US of around 0.75%. At this point in time, looking into 2023, this doesn't mean that we are at the end of the monetary policy tightening cycle. As I say, more work is required to be done. In this point, the US is expecting to see interest rates of around 4.75 to 5% by the summer of next year, but the trends which we're seeing may provide the Federal Reserve with some breathing room within their decision taking, likewise here in the UK. Thank you very much for watching.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.